the starting point is to say, we're in your corner, we're aiming for the same outcome. If you get a great outcome, we get a great outcome. And there's genuine alignment. Sometimes in order to maintain that alignment, you have to have difficult, confronting conversations. We work very hard, I think, to build a level of rapport, a level of trust, such that if and when we do need to have those difficult conversations, they come from a place of genuine friendship and willingness and desire to be helpful, both in terms of the business and sometimes in a personal context.
Hi everyone, I'm your host Rohit Bhargava, and you are listening to episode 183 of the Startup Playbook podcast, a weekly series where I sit down with successful tech founders, investors, and operators to unpack their journey, lessons, and insights to help current and future entrepreneurs. The voice that you heard a little bit earlier was that of our guest for this episode, Howard Leibman. Howard is the founder and general partner at EVP, a venture capital fund focused on B2B software companies in Australia and New Zealand. In 2023, they raised $100 million for its fourth fund, taking their total funds under management to $300 million. This is Howard's first ever podcast interview, and in this rare one-on-one chat, he opens up about his career and journey so far, EVP's framework for making investment decisions, changes to a founder's role as a company scales, being the founder whisperer, and much more. Without further ado, here is my interview with Howard Leibman. Hi, Howard. Welcome to the Startup Playbook podcast, and thanks so much for taking the time to be on the show today.
My pleasure. Thank you, Rohit. It's good to be here.
I know you don't do very many of these. Some people that I spoke to are very surprised that you were coming on to a podcast as well. So right. Really do appreciate you coming on. Howard, for those people that may not be as familiar with you or your background, do you want to share a little bit about your story and what got you here today?
Sure. So I started out life as an engineer. Way back when, I studied electrical engineering and began my career. I spent 4 years as a design engineer with General Electric back in the day. I then was very fortunate to take 2 years full-time to business school for an MBA, and after which I had a very short stop in consulting and then joined I guess what you'd call a boutique investment bank called Emerging Growth Capital. It was a sort of a boutique advisory firm, full service in the sense that we had corporate finance, institutional broking, research and funds management, but all with a very clear focus on technology and life sciences. And I spent a number of years in the corporate finance team there, doing a range of advisory transactions and equity capital markets type work. I think the most relevant of those was a business called Heartware, which was an extraordinary medical technology company, a US venture-backed, incredible technology at the sort of cutting edge of fully implanted medical devices, which I can talk to in a sec, which, again, for an unusual set of reasons, chose to list on the ASX. Again, it might make in itself for an interesting conversation. We were the advisors and the underwriters to that particular IPO, and after the ASX listing, I left the world of investment banking and went in-house as head of corporate development for that particular medical device business. So I spent 5 years or thereabouts heading up corp dev, during which time we did a dual listing on NASDAQ. We raised a bunch of capital. Over time, the liquidity transitioned almost entirely to the US. We ended up delisting from the ASX, and the company went on to become a very successful NASDAQ-listed global medical technology business, ultimately acquired by Medtronic for well over $1 billion. After that particular journey, I started doing some work with, I guess I was trying to figure out where to from there, and I found myself doing a bunch of work with some amazing, very early startups at their most formative stage, businesses that many of which have gone on to do some amazing things, companies like Shipit and Resdi and Deputy and a number of others, where I was doing some advisory work, I was helping the founders, I was raising small amounts of capital, doing some small investing myself. And it was in that context that I kept bumping into Les Zekeli, who was by then already well known as an established angel investor, having had a very successful outcome from a company called Hotel Club. Again, a story in and of itself. And Les and I found ourselves working on a number of opportunities together. Again, those names that I mentioned, Shipit, OneFlare, SiteMinder, Resdi, Design Crowd. And initially we were working together independently, if you like. That led to a decision to start sharing offices, which led to a decision to formalize a partnership back in 2011, 2012 timeframe. So that was really the genesis of what has become EVP. And then very quickly, fast forwarding, it was actually prompted by the Turnbull Innovation Agenda with the launch of the USVCLP program. We decided in 2015 to raise a fund, effectively to continue doing what we were doing anyway, but in a tax effective structure, right? So we raised our first fund in 2015. We launched the fund in 2016. It was a relatively small fund, a $25 million fund at the time. We invested across a portfolio of 11 early stage software companies. And I guess that was the catalyst that started us on, I guess, more of a conventional VC funds management type journey. We went on subsequently to raise Fund 2 in 2018, Fund 3 in 2020, Fund 4 in 2022, and along the way have grown from it being initially just Les and myself to Justin and Dan joined us very, very early, 2015, 2016 timeframe. The four of us remain very, 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 I guess, a very sort of coherent partnership, I guess, some many years later. And over the period of time, we've grown from the four of us to now a team of 13 and some 40-odd portfolio companies across 4 funds and about 15 SPVs.
Amazing. Obviously, an incredible story and journey, all of which we'll dive into. Do I have this correct that you did a double degree in engineering and arts?
You too, a long, long time ago.
Yeah, not a very common double degree. I did a double degree in engineering and economics, but what made you choose to do a double degree in engineering and arts?
Look, I think I'd always enjoyed, maths, physics, chemistry. There was a natural inclination towards engineering. I was, I think, 1 year into the degree when I took on the BA in parallel, just out of interest, to be honest. It was never anything beyond that, right? I did history and philosophy just as a means of adding something less technical to the degree.
Yeah, interesting. And from my experience, and coming from a family of engineers, everyone once on that path stays on that path for a very long time. As you mentioned, after your MBA, you moved into the world of investment banking. Was that always like part of your plan, or how did that sort of pivot in your career come about?
Yeah, to some extent, it was always part of the plan. I think it was certainly more so then, perhaps still to a lesser extent. It was a very well-trodden path to start out as an engineer. I think it still holds that the discipline and the sort of core skills learned as part of engineering training set oneself up really effectively for a career in all sorts of other areas. So I think to some extent I always had the intention of doing the engineering degree, perhaps working for a little while in engineering, and then finding a way to transition into the finance or business world, I guess. The motivation for going to business school was firstly because I'd figured out fairly early that I wasn't likely to be a particularly good engineer, but I think there was always an intention to go into either consulting or investment banking. It was, part of the plan from fairly early on. Yeah.
And you mentioned through your work in investment banking, you came across Heartware, which you ended up after the listing going and joining in-house into their team. Again, I imagine at that time you're getting exposure to a lot of different companies and a lot of different things. What was it specifically about Heartware that made you want to leave investment banking, go in-house?
To be honest, I could probably talk about that business for this entire session. Heartware was a genuinely extraordinary technology business. So what the company developed was what's called an LVAD, a left ventricular assist device, which was a mechanical continuous flow pump that was inserted into the left ventricle of patients in end-stage heart failure. Right, so these are patients who are at the very end of the line, effectively, and this device was used as initially a bridge to transplant. So it was used to bridge them through until a donor heart became available, or subsequently, as we worked through the kind of regulatory accreditations, we became accredited as, in addition to the bridge to transplant, it became used as what was called destination therapy, which was effectively as an alternative to transplant for those patients for whom a donor heart wasn't available. So incredible technology that literally took patients from quite literally death's door to being up and about and walking the dog a couple of weeks later. The underlying engineering was extraordinary. So again, this is a fully implanted pump that was driven by a controller and a battery pack that the patients wore around their belts. Incredibly precise engineering, extraordinary technical capability within that team, unlike any I'd ever seen. So I guess it was extraordinary technology that had a genuinely transformative effect on the life of its customers, in that case, healthcare patients. Along with that, there was a really interesting finance journey, if you will. It was venture-backed by a US venture fund, and I guess it provided me a direct visibility of the incredible value that could be built by an active patient private investor who takes a long-term view on a technology story with a meaningful degree of risk, selling ultimately into a very large market. But being part of that journey from US venture through to ASX public, ultimately to a NASDAQ listing, was, I was very, very privileged to have been part of that journey.
One of the things that you mentioned a little bit earlier was that a unique part of their listing process was to list on the ASX.
Mm-hmm.
Initially, what kind of drove that decision?
This is quite a long time ago, right? It was a really interesting financial sort of corporate finance kind of decision. The business, as I say, was backed by US venture. There were at the time a very small handful of competing products, one of which was a company called Ventricore, which happened to be an Australian technology success story at the time, listed on the ASX. So there was a certain valuation that was being ascribed to that particular company by the Australian public markets. And it turned out that the valuation that the business could achieve in a later stage US private round was less than could be achieved in the Australian public markets by virtue of the direct comp in Ventricore in that case, which underpinned a certain valuation expectation in the public markets. So it was something of an arbitrage in that it was very much a US business funded by US venture, taking advantage to some extent of a willingness amongst Australian public company investors to pay a higher valuation than would have been available in the US private markets, with a view ultimately to bridging from US private back to US public. So we went US private funded through an ASX listing, and then, as I say, we dual listed on the NASDAQ. We attracted over time a number of US specialist healthcare funds who became the core investors in the business. And as the liquidity in the ASX tended to diminish, as it shifted almost entirely to the US, as I say, it made sense at that point to delist from the ASX and to become a sort of fully fledged NASDAQ-listed technology story.
Yeah. And as you mentioned, it sounds like an incredible piece of technology and an incredible product.
Yeah.
One of the interesting things about interviewing a lot of investors on the show is just seeing how a lot of their experiences through their career, businesses that they've built, or just businesses early in their investment record sort of shape the way that they think about broader investment strategy. We're starting to experience that a little bit ourselves with Playbook Ventures, but how did that sort of specific experience with Heartware shape how you think about investing in businesses or founders?
Yeah. Look, interestingly, the type of investments that we make today out of EVP are a world apart from investing in class 1 medical devices. It's a fundamentally different investment lens, investment framework. The world of medical technology is incredibly capital intensive, hugely expensive to get a product into trials, enormously complex regulatory path, very expensive in every respect. But the payback for that is that there are equally massive barriers to entry, and once a product is approved and in market, the cash flow that results over a sort of sometimes a multi-decade time frame are extraordinary, right? So a very different risk-return type framework from what we do, which is overwhelmingly B2B subscription software. But there are certainly some commonalities, which is the focus on technology, the focus on team, on amazing people, focus on ensuring alignment between, in terms of capital structure. Those sorts of lessons I think were, well and truly translated. But I'd probably take it in a slightly different direction. I'd probably say, having seen the cost and the complexity of a deep tech investment such as that, if anything, it swayed me in the opposite direction. It swayed me towards the world of subscription software, where inherently there they're capital light business models. Inherently, they're scalable. Inherently, there's opportunity to build distribution very effectively and with relatively little capital, which is at the very opposite end of the spectrum relative to, as I say, an implanted medical device.
And you mentioned this sort of after leaving Heartware that you were trying to navigate and figure out what was next for you, and you got into sort of angel investing and advising companies. What did that sort of process look like? Because again, speaking to a lot of guests on the show, it's very easy to draw those sort of lines on their careers and looking back and go, of course, things make sense. Mm-hmm. But at that kind of moment in time when you're trying to figure that out, what did that sort of look like? Did you at the time think that you would, given your experience within that sort of medical medtech area, to double down on that? Or as you said, was that kind of particular experience help shape you in the opposite direction, which is more that you wanted to go down and work specifically with companies that didn't have those barriers in place?
Yeah, look, truthfully, it was far less deliberate than that might suggest, right? I think post what was a successful journey with Heartware, I think I probably assumed I could be useful to emerging life science and medical device businesses. The depth of opportunities in Australia really wasn't there, and it became clear fairly early that it wasn't going to be a particularly fruitful path to go down. And I think just in the context of exploring opportunities, I found myself probably falling back on the early engineering degree and I guess an appetite for early stage technology companies that I'd always had, and found myself, as I say, working with a number of these very early stage online businesses, and one thing led to another. So before I knew it, genuinely, I was working very closely with those companies that I mentioned, the OneFlares and Shipits and Resdes and Design Crowd and etc. And I guess the more time I spent with those early stage software companies at their most formative stages in each of those cases, the more I realized that this was the type of business model that I really wanted to, and that really was the genesis for what's become EVP over the years.
And you mentioned you got in at the very sort of formative stages of that. I believe even with the Shipit deal, so I've had Will on the podcast before. Right. Again, correct me if I'm wrong, but did you help them leave their jobs and help them get their sort of first round of capital?
I don't know if I helped them leave their jobs, but it was and Will and Rob are, you know them, right? They're two of the most compelling, most engaging, best founders in certainly in our portfolio, and I think in Australia more broadly. What was quite extraordinary about the two of them in the very early days, and I'm sure you've heard the story before, right? They both had very successful early careers in their respective corporate roles. I'll get this wrong, but I think Rob was at Procter & Gamble, and I think Will was at possibly Deloitte, so one of the consulting firms. And I think they were building very successful careers, and I think they would have gone on to build very successful corporate careers in their respective roles. They were really moonlighting building Shipit, right? They were doing it on weekends and at night, and it had become something of a passion project for the two of them. I was introduced to them via, in fact, it was the founders of OneFlare, I think it was, who introduced me to Shipit. Really, they were thinking about whether they should raise capital. It was really at that, as I say, at the very, very early days of the two of them trying to figure things out. And I do distinctly remember a conversation, I don't know if they would remember it, where they asked if I could help them raise capital. And I said, look, I think what you guys are doing is super interesting. I think the two of you as a founding team are incredibly compelling. No one's going to write a check while you have a day job, right? So if you get to the point in terms of your level of conviction in this opportunity, if you get to the point where you quit your day jobs and you're willing to jump into this full time, I said, I'm sure at that point, raising capital would not be a big ask. So whether that conversation prompted it or not, I don't know. But I do remember them coming back to me saying, so we've quit our day jobs, we're all in, and let's go. So I was, as I say, very fortunate to have been at the very beginning of the Shipit journey, and brought Les in as part of a small syndicate, as part of the original investment in that business.
And I guess sounds like you had a certain level of conviction in them as founders and in that opportunity, perhaps a little bit more confidence than they had at that particular moment in time of just not knowing about that particular step. Oftentimes it feels like founders have to it being the other way around. where founders are convinced and going out to raise capital and trying to convince investors to come on board. What, in that specific instance, and you mentioned a couple of others as well, what is it that kind of gives you that conviction? I know it's never any one thing, but is it, in that particular situation, is it about the company and the market opportunity? Is it about them as founders? I assume there's some combination of the two.
Yeah, I mean, this is going to be a bit of a cop-out of an answer, but it's all of that, right? I think they'd identified a really interesting market opportunity. In reality, the nature of that opportunity shifted materially as Shipit matured, but the early use case was really interesting, and I think it was that in combination with the two of them as founders that I found very compelling. Having said that, when I wind the clock forward to the way we operated EVP, and I don't know if you want to go there yet, but we would never invest through EVP in Shipit back in the day, right? And I guess that's also through lessons learned along the way in terms of the genuine level of risk taking what was a pre-seed bet. So with an EVP lens, and we've really doubled down on this strategy now over the last 10 years or so, we'll invest early. We like investing early. We're very often the first institutional check into our companies, but we'll never invest pre-product. We'll never invest pre-revenue. We'll only ever invest at a point where there's product in market, there's a good early base of paying customers, there's healthy revenues, there's a level of underlying metrics where we can get into the data and we can understand the extent to which we can understand underlying engagement metrics in a way that you really can't at a seed stage bet. So whilst I loved the time spent with some of those companies at that very, very early stage, it equally informed a view that as to where, from a more institutional investment perspective, it informed a view as to where the right risk return point of entry might be. And that's led us very deliberately to a kind of a Series A stage mandate.
Yeah. I guess maybe to draw on that a little bit more, can you expand on why that sort of risk is so high? Because I guess on paper, you would look at what Shipit has gone on to achieve and some of these other companies that you were involved with quite early, say, clearly you have an ability to pick these founders and pick these kind of companies earlier on. Why, I guess from your perspective, like why that specific risk profile being too high, and why focus just on Series A?
Yeah, it's a really good question. I just think, just by its very nature, investing at that pre-seed stage it's just inherently more risky, right? I think with the most compelling pitch and the most compelling and convincing founders in the world, there is nothing quite as validating as acquiring your first few customers, generating your early revenue, seeing the levels of customer engagement, in order to legitimately, in order to validate the extent to which the product actually does what it says on the box, right? And I think for every Shipit that has been successful and for every deputy that has been successful, there are dozens that haven't. We all know this, right? And I think that's just fundamentally the difference between a pre-seed and seed stage investor versus our preference, which is to invest just slightly later. So I guess the way we would think about it is the frame of reference for a very early stage bet, to your point, Rohit, is to say, is there a really interesting market opportunity, and do we really back the founder? I guess in our and that's everything, right? When you're making a seed stage bet, everything is you're placing a bet on the founding team on the basis that there's an interesting product and market opportunity to go after. The way we think about it is both of those have to hold, right? Obviously, we're looking for huge global markets. We're looking to back amazing founding teams. But the starting point is to say, let's have a look at what the underlying metrics are doing, right? How many customers have you acquired? What's the rate at which you're acquiring these customers? To what extent are they adopting the product? To what extent are they sticking around? What does the retention look like? What capacity? What do the trends look like in terms of expansion? Do they churn? Do they stick around? And if you view that data on a cohort basis, are those metrics improving or declining over time? So it's more of a, and by the way, once the signal in that data tells us that the product appears to be solving the problem that our customers are looking to solve, then you're saying, is this team amazing, and can this team take this product the distance, right? And that's not to say that we prioritize the one over the other, but they both have to work hand in hand, right? It has to be an extraordinary market opportunity with underlying metrics that are telling a very, very interesting story with a team that can really take it to the next level. So in some respects, I'd almost categorize it as it's a little bit like a sort of a growth equity framework applied at an early stage, right? We'll only invest when we can underwrite to a certain outcome based on the data, which is clearly impossible to do at a seed stage bet.
We're going to take a very quick break from this podcast to talk about an important issue that I see coming up time and time again. And that's how difficult, time-consuming, and expensive it can be to get your ISO 27001 and SOC 2 compliance. These certifications are so important in building credibility and trust with large enterprise customers, but can be such a big distraction and operational drain for early-stage companies. Thankfully, there's a tool to help with this. Vanta helps companies get and stay compliant by automating up to 90% of the workflow for the most in-demand compliance frameworks. And with over 300 integrations, you can easily monitor and secure the tools that your business relies on. There are over 7,000 fast-growing companies like Atlassian, Flow Health, and Quora that use Vanta to manage their risk and prove their security in real time. Vanta have been a great partner of the show and have doubled down their support for our community by offering $1,000 USD off their plans. To get access to this exclusive offer, head over to vanta.com/playbook. That's VANTA.com/playbook. All right, let's get back to this episode. A very selfish question. So we specialize in investing in pre-seed, and one of the benefits that we've had is we've been able to back founders who have had exits previously and are going again. And so the data point that we have is his founders with proven track records, and there's still a lot of unknowns, but operationally there is some kind of risk that you're mitigating. One of the questions that we ask ourselves is, as you said, with the founders of ShipIt and some of the other founders that you've backed, in hindsight, it's a lot easier to say these are outstanding founders. How do you discover them before they have those particular data points in place as well? I guess from your experience in investing, are there particular signals early on with founders that you see that kind of give you that sort of kernel of imprint or data point, or something that you particularly look for that stands out for you?
It's the question, right? I am incredibly, I love the fact that you guys and others like you take those very, very early stage bets and help these very early businesses, or not even businesses in some respects, back these founders to build to the first phase of being able to demonstrate customers and traction, etc. I think it's an incredibly important, essential part of the ecosystem that we're collectively building. So I don't want in any way to suggest that I'm not massively supportive of pre-seed and seed stage investors. I am every which way, and in some respects, I would love to be able to make those bets, because from time to time we'll meet founders and we'd go, we absolutely love that founder or that founding team. The one thing that I think we have done effectively, hopefully one of many, but certainly one thing we've done effectively at EVP, is to be really disciplined in terms of the guide rails. So there are some sort of immovable rules which we just won't break, right? Mm-hmm. And one of those is product and market and revenue and customers, etc. So as tempted as we are to back some of those founders that you describe, we just can't do it within mandate. I know that doesn't answer your question. To the specific characteristics that we look for, again, this might be slightly different from our frame relative to a pre-seed stage or a seed stage bet. We're looking for the same characteristics that you'd think of, right? Grit, perseverance, hustle, smarts, the core competencies that we all like to see in our founders. I think with us, there is a slightly an additional overlay which speaks to specific relevant industry perspective. And this is not a rule on the way in, but when we look at our portfolio retrospectively, it turns out that a significant number of our founders are coming from within an industry, right? They've grown up in a particular sector, they've operated within a particular sector, they've identified a problem, a shortcoming, an issue to be solved within their industry. They've come with a very specific perspective. They've sought to solve the problem for themselves, and that's been the genesis of a business, right? you mentioned Guy at Ignition before, right? Guy is an accountant, right? Guy operated a sort of a mid-sized accounting practice. He was looking to find tools to migrate his accounting business into the cloud, couldn't find the tools, and that really was the genesis of what became Ignition, right? And I could speak to a dozen other such examples. So I think it's a combination, back to your question, a combination of drive, commitment, grit, a clear ability to motivate and build a team and inspire and paint a vision, all that stuff, with a very clear industry perspective that gives the founder an edge in building the particular product, addressing the particular problem in their specific industry.
You mentioned guardrails and having set rules that you don't break. Are you able to share what those rules are, or at least give a guidance in terms of like what's important from an EVP perspective?
Yeah, absolutely. And look, I at risk of repeating, it's pretty much, it's along the lines of what I've described. I think there is a line in the sand which says, whilst we like investing early, we cannot invest too early. And by that I mean there needs to be a threshold level of traction in order for us to even get to the first square of the conversation. We're often asked, what does my ARR need to be in order for us to be interesting from an EVP perspective? And the answer is a bit tricky because we don't have a clearly defined ARR threshold, right? So if we see a company that has, I'm making this up, 3 customers at $500,000 each, generating $1.5 million of ARR, that might not be terribly interesting to us. Whereas if we see a business perhaps with more of an SMB focus with 50 customers at 10 grand each, that's far more interesting, right? So there's not so much an ARR threshold. The threshold is what level of density is there in the underlying metrics such that we can make a data-led decision and a metrics-based decision on an investment. And that varies from company to company as to what that threshold is. But the genuine kind of immovable in terms of guide rail, I mean, if you see our investment papers, there is absolutely a section which talks about the founder and why we particularly want to back this particular founder. And again, coming back to my previous comments around specific perspective and specific right to win in this particular industry. But our investment papers are data heavy. They're metrics packs, right? And they dive into customer concentration and quality of revenue and margin performance and cohorts and retention. And it's very much a metrics-based financial analysis. Again, probably more akin to a growth equity type framework than to a very early stage venture investor. Unless there is enough early traction and sufficient early data points to be able to build that case from a data perspective, we just can't go there. Like we literally couldn't bring an investment paper to the IC without that level of data.
Yeah, I'm curious whether you mentioned the natural question that you get asked is like, what is the threshold? I'm wondering whether is there not necessarily a quantum, but like a rate of change within that. So you might not have, let's say, $200,000 monthly recurring revenue, but the rate of change of that from month to month. I guess I'm just trying to gauge, like, when you say that you need enough data, what is enough data, and what are like signals that really stand out to you as these are early indicators?
So, having described the framework that we tend to use, it's very rare. It's rare that we're investing in a business that's doing less than $1 million ARR. It's far more likely to be doing 2 million plus. It's very rare that we're investing in a business that's growing at less than 100% year over year, including when they're doing $2 and $3 and $4 million of revenue. So if we look across our current fund, we're investing through our 4th fund, we're 9 companies in. I would say average ARR across those 9 companies at the point at which we invested is probably somewhere between 2 and 3 million. And the average revenue growth rate across those companies is probably in the order of 140, 150% year over year. So that's the kind of headline metrics that gets interesting. And then next level down is, can we speak to a dozen customers? Can we understand the extent to which the signal for us is that when we see metrics like that, the metrics tell a lot of the story, right? Because you don't see that level of adoption, that level of expansion and growth, unless customers are really leaning in. And then we look to validate that by speaking to dozens of customers. And when we hear, man, this product is changing our world, right? This is changing the way we go about business. That's the point at which we get very excited about an opportunity.
One of the interesting things about EVP as well and your journey is you've been in the game for quite a while, and a lot of the companies that you invest in earlier are now later stage. In my kind of conversation with Will, and I didn't realize this prior to speaking to him, was the role between him and his co-founder flipped at some point through the process. And as the opportunity and as the company changes, you require different skill sets across that. I guess as an investor that's there from like Series A and beyond, how do you look at that from a team perspective and from an investment perspective as well?
Yeah, really good question. And it's something we spend a good amount of time thinking about. I think, again, coming back to the assessment of the founder on the way in, I think there is a view amongst many early stage investors that you back the founder today and forever, right? And that's the sort of modus operandi on the way in. I think we're quite open-minded about that. That's clearly what we all want to happen, right? And I think it's probably fair to say in unusual circumstances, the founder who can take the business from 0 to 1 is the same founder that can take it to 1,000 staff. It's often not the case, and I think we need to be, or we are very open to founder transitions at appropriate points along the journey when it just makes sense to bring in different levels of capability and different levels of experience. So we've seen that happen, a handful of times through the portfolio, and I think in every case it's been significantly in the interest of the company and massively in the interest of the founder, who remains a major shareholder but just steps out of the day-to-day operational sort of responsibility in the business. So again, I think we're at the point of making the investments. Again, our hope is that founders go the entire journey, and that's very much part of our assessment at the get-go. Is this a founder or a team who can grow at the same rate as the company is likely to grow? More often than not, our assessment is yes, but with eyes wide open that things can change over time, right? And I can speak to examples if that's helpful. Yeah,
I'd be curious, I guess, what are the signals that, as you said, no one walks into it with the intention of making a change, but situation, circumstance, just things happen over the course of a long-term journey for each of the companies. What are indicators that stand out to you that it might be time for a change?
Yeah. Look, it's rare that we're seeing signals and we're imposing a change. I mean, one of the things that we pride ourselves on and we work very hard on is so back to your previous question, some of the immovables or the sort of guide rails of an EVP, we lead every round, we take a board seat on every company. We really do aim to be very active, helpful, long-term partners to our founders. So that's the context. It's very rare that we get to a point where there is some sort of signal where we decide we have to make a change, right? In almost every situation, it's a conversation that evolves over a many month period, usually instigated by the founder, who's perhaps not enjoying it quite as much as they once did. There's a phase in the business where you know every customer, you know every staff member, you are everything in the business, to the point where perhaps there's 50 staff, you've got intermediate layers of sort of organizational structure, you no longer have the direct relationships with the sort of frontline salespeople. The role becomes more the carrier of the culture and organizational management, as opposed to the sort of day-to-day growth priorities that you have when you're smashing through doors to get to the first $1 million of revenue. The nature of the role changes, the nature of the motivation changes, and I think often there's a recognition that says, you know what, others could perhaps do this job better than me, and others would probably enjoy it better than I do. Maybe it's time, in the interest of everybody, to step aside. And again, these are generally constructive, positive, aligned conversations, right? So again, it's very rare that we would walk into a board meeting and say we're changing the CEO. We've never done that.
Yeah. To counterbalance this, we've referenced him a little bit, but Guy Pearson from Ignition, who I've also previously had on the podcast, I spoke to him as part of the research process of this interview. And
right.
One of the things that he mentioned, and also came up in my chat with Justin, who said someone in your team called you the founder whisperer recently.
Right.
One of the things that Guy mentioned is that, and he said it's very rare, but his line was, as founders, things are always going wrong and you lose your shit through the process. And he said there have been multiple times where he's like walking the ledge through conversations with you where he can be really open. You've, again, in his words, talked him off the ledge with a lot of those sort of things as well. And again, we've obviously spoken about the sort of the side of kind of deciding that founders aren't quite particularly right, but for anyone who's run a company knows, even from the outside looking in, where everything looks like it's going swimmingly well, everything's on fire on the inside, and part of an investor's role is to kind of like help navigate that and support the founders as well. Again, can you like share, I guess, how you see part of that role, and especially taking board seats and taking quite active roles within these companies? What does that look like?
Yeah, I've never heard that term founder whisperer, I have to say, but it's interesting. I think, and I hope Guy and others would say this, I think the starting point is to say, we're in your corner, like genuinely. There is likely to be disagreement or perhaps divergence of interest to some extent over time, but the starting point is to say, we're in your corner, we're aiming for the same outcome. If you get a great outcome, we get a great outcome, and there's genuine alignment. Sometimes in order to maintain that alignment, you have to have difficult, confronting conversations. We work very hard, I think, to build a level of rapport, a level of trust, such that if and when we do need to have those difficult conversations, they come from a place of genuine friendship and willingness and desire to be helpful, both in terms of the business and sometimes in a personal context. And I think maybe I can use an example. I think Resdi was one such example, right? Where, I don't know if you know the Resdi story, but Simon Lenoir was the founder of Resdi, extraordinarily capable founder, built the business to a really great scale, but self-selected at a point, saying the business is now at a scale where perhaps we could probably do better in terms of the sort of the kind of leadership priorities from here on in. And anyway, we had a number of tricky conversations as part of that transition some years ago now. I think with hindsight, Simon would say the decision to step out of the CEO role into a non-operating shareholder and director role proved to be absolutely the right decision. We've subsequently exited Resdi for a very healthy sum. Simon stepped out with a very healthy return. He's now building a new startup, and I suspect we may well be the investor in the new startup, right? And there is a very close ongoing relationship where I would love to work with Simon and Simon would love to work with me, I think, notwithstanding the fact that we had difficult conversations and a challenging period of transition over the course of the journey.
You would have heard me say many times on this podcast before that I am such a big believer in surrounding yourself with the right people. And that's why I'm delighted to partner with Sender. Sender is the OG startup accounting firm in Australia, catering to all stages of your business life. If you're busy running your startup, you don't always have the time to balance your own books or do forecasts, and instead you can fully outsource your finance function to give you the time, energy, and resources that you need back to do what you do best, which is growing your business. They have a dedicated focus on founders, funders, and startups, and have an experienced team that can help you with everything from managing your tax to balancing your books to even helping with your exit strategy. I trust and use them with all of my businesses and can't recommend them highly enough. To find out more or to speak to Gareth and the team, head over to sender.com. That's SCENDAR.com. All right, let's get back to this episode. So, first of all, congratulations on the announcement of Deputy hitting the $1 billion valuation.
Uh-huh.
One of the stories that sort of came up that kind of points to the relationship building that you were just speaking about was for Deputy Series B, there was a $128 million round. EVP put in $2.8 million, but still retained a board seat based on the relationship that you had. I think it's often a point for a lot of founders that the sense that I get is that they don't really feel very comfortable opening up to their board members or to their sort of investors in a way that's truly open and transparent. But as we've just spoken about with the story with Guy, they're in your corner, investors are in your corner, and they want what's best for you and for the company as well. Do you have any advice from your perspective in terms of how founders can and should build those relationships and lean on their investors or their board?
Yeah, a good question. And I think it is true to say that with the best will in the world in terms of building rapport and trust and transparency, it does nevertheless remain the case that the founder reports into the board, and there is inevitably there's a sense of the founder's existence being fairly lonely, because it's very difficult to have a conversation to the extent there is dissonance around the board conversation. It's very difficult for them to have a conversation with a board member around solving that. So there again, with the best will in the world in terms of building really close, transparent relationships, there are times where it's fraught and it's difficult to navigate, and that happens, and hopefully the relationships are such that you can navigate through that. I think maybe specifically to your question, the relationships that I think work well or work best are those where there is meaningful ongoing interaction outside of the board cycle. So at the point at which we first invest, I mentioned before, the companies are relatively early. They're relatively small. They're just figuring it out. They're building their go-to-market. They don't have board meetings, right? And board meetings at the point at which we invest, they're management meetings essentially, and they're very informal, very frequent. So there'd be a board meeting, if you will, every month, and they're very operationally focused. We're deep in the Slack channels and in the metrics and in their CRMs, and we're part of the sort of operational decision-making process, if you like. As these businesses grow, you mentioned Deputy, right? Monthly meetings become every second month, become quarterly. The nature of the meetings becomes less operationally intensive and far more strategic in nature. And there's a little bit of a distance that begins to build between the board of directors and the investors on the one hand and the CEO and management team on the other, just by virtue of getting together once a quarter. So to address your question about how a founder should ensure ongoing good rapport and good engagement with an investor, it's absolutely not to rely on the board cycle, right? It's to be catching up. We have catch-ups with our founders on a weekly basis, almost across the board, right? And it's in those weekly catch-ups where, to be honest, the real relationship is built, the real conversations are had, the real decisions are made in many respects, because there's a currency to the conversation rather than the sort of quarterly catch-ups, which tend to be much more reporting and compliance and governance just by their very nature. So I would encourage all founders to find a way to engage frequently with their investors in a way that is deliberately outside of the board cycle.
You know, obviously, as we've touched on throughout this interview, you and EVP take on a very sort of active role within the portfolio companies that you have. Obviously, in Australia, we're seeing emergence of a lot of different funds and different sources of capital for founders, which is fantastic, but also a lot of funds that are getting significantly larger than they were early on, which means that they've got larger portfolios and probably not, you only have so much time. Mm-hmm. Splitting that between X number of companies becomes harder and harder with the more companies that you have. It seems that EVP's been very, to use your word, disciplined in terms of how you invest. Even your fourth fund was 100 mil. Mm-hmm. Has that been strategically like a very important and deliberate move to remain relatively at that size rather than looking to raise it at the other end of the extreme of $1 billion?
Okay, so there's lots there. I think in terms of us being active, I think most funds will claim a level of active investment in terms of strategy. That's just the nature of early stage venture type investing. But I think we probably are more active than others might be. I think that's just our DNA is to be very much part of the team and part of the operations. You mentioned Justin. I think if you were to speak to some of the founders who Justin works with very closely, the likes of companies like Henry or Mutinex or others, the level of engagement is weekly and daily. It's deep involvement in the decision-making processes. And the relationships evolve into very real friendships, right? So there is a very deliberate active partnership model that we try to pursue. You're right to point out that doesn't scale well. There are bandwidth limitations as the number of companies in the portfolio grows. So those of us who are on board seats start to spread thin. That's probably one of the most active strategic conversations that we have within EVP as we build the business, as we build the franchise. It's to what extent can we at the same time be true to building the number of companies in the portfolio and at the same time be true to the active partnership model that is so fundamentally important to us. A couple of things happen. One, we're happily at a point where we're cycling out of Fund 1 companies. So Fund 1, we invested in 11 portfolio companies. We've now sold 6 of them. We have 5 to go. But as we sell early assets, so we're sort of freeing up management bandwidth, if you like, to take new board seats. So there's a natural transition that occurs as we're selling down from Fund 1. We're investing into Fund 4. The other thing that has happened, and somewhat obviously, over time we've materially built the team. I think one of the things that I am most proud of, and I think we have built over the period since we launched EVP in 2014, we've built like a genuinely extraordinary team where I think there's capability in the investment team that I would genuinely say is second to none in the market. And so we're now a team of 14, and a number of the members of the investment team who've joined us early are now, at the sort of investment principal level and taking board seats. So, to be very specific about it, Mark Velick, who in fact is, I think his 5th anniversary is like next week. He joined us when we would have been investing through Fund 2. He is now 5 years in. He is deeply taken on the way we operate and the types of business we look for, the type of analysis that we do, the types of relationships we like to build. And Mark is taking on a whole bunch of board seats in Fund 4. So, and I very much hope that will continue, that as we expand the portfolio, so investors come through the team and increasingly take on some of the new board roles. And then finally, to your final point about capping to some extent the size of the fund, all of that is true, right? I mean, I think the decision to cap the size of the fund has in part to do with bandwidth, but it also has in part to do with, let me rephrase this, it has primarily to do with being true to our Series A focus, right? There are 2 somewhat conflicting elements. The one is to say we want to build really concentrated portfolios. Fund 1 was 11 companies, Fund 2 was 11, Fund 3 was 13, Fund 4 will be a dozen. So they're concentrated portfolios, but we're investing at the Series A stage, which means we're writing checks between 2 and 5 initially, with a view to doubling down after that. But if you choose to scale a fund much beyond that 100, the risk is that something has to give. Either you're investing in a broader number of companies, so you're compromising on the portfolio concentration, or you're having to write bigger checks, which means you're investing later stage. And it's quite difficult to be true to both those core elements of our investment strategy, which is Series A stage investment and concentrated portfolio, if you start to scale a fund significantly beyond where our current fund size is. Having said that, I think over time we'll raise larger funds, and to some extent that's inherent in building a venture franchise. But those larger funds will help us take on some of the sort of growth stage rounds that are becoming increasingly prevalent across the portfolio, rather than compromising on the core Series A strategy.
Mm. And you mentioned, maybe to wrap up, you mentioned Mark Velick being on your team. Obviously, I spoke to Justin Lipman, who's been on the podcast before as well. Justin actually told me a funny story about his first meeting with you, where both of you down 4 to 5 beers each. But one of the things that he also mentioned was that how grateful he's been for the opportunities that he's been provided by you and Les and Trust in, as you mentioned, taking on these board seats with a lot of these companies, which are really important experiences and trajectory markers for a lot of these investors in your fund that may not be possible in other funds as well. Clearly, you put a lot of trust in the team around you, but also sounds like you spend a lot of time in kind of building that right team and that right structure and kind of creating that culture. Maybe just on a final note, would be curious to know, what do you look for in people that want to come and work at EVP?
So a few things. I think I remember very well those beers with Justin down at Circular Quay. I got very, very lucky on that day. And I mean that like very, very genuinely. It was Les and myself figuring out how to sort of transition from the two of us doing our thing to more of a sort of funds model. I was introduced to Justin via a mutual friend. I caught up with him, and Justin was on a sort of fast-track investment banking career at Credit Suisse at the time. We caught up for a beer, and I think the pitch was, we're building this incredible venture capital fund. We don't yet have a fund, but we'd love you to forego the investment banking opportunity and join us on the journey. So it was a pretty shaky pitch, to be honest, and the fact that he did join at the time and has made an unbelievable contribution to building EVP as a franchise over the years. It's nice to hear that he was grateful. I am beyond grateful for his partnership and his involvement. I think more broadly across the team, I think one comment that maybe speaks to it is we've never had anybody leave. We've never had anyone on the investment team opt out. And I think that goes to a degree of, I think we're very thoughtful, and selective has poor connotations, but in terms of the types of individuals we like to bring in, we're currently, this is a little bit self-serving perhaps, we're currently recruiting for an associate role, right? And this is a commentary, I guess, on how the VC industry more generally has really come of age, right? But our shortlist in terms of the associate role is McKinsey, BCG, Bain, Goldman's, and JP Morgan, right? These are extraordinarily capable associate level execs who are desperate to get into the sort of world of venture, and hopefully are considering EVP as a sort of an attractive next phase of their career. I think in thinking about who we bring in, technical skills is a given. I spent some time before talking about the types of, the nature of our investment process. It's analytical and it's rigorous and it's data heavy. It's a kind of a given that's a core skill set that we must have. But then there's significant focus on cultural fit, on motivation, on alignment with our values, if you like. And again, so far we've been incredibly fortunate to have built a genuinely exceptional team.
Howard, thank you so much for coming on this podcast.
My pleasure.
You are incredibly understated, but I'm sure that anyone on this podcast will attest to just the amount of information, experience, and value that you bring to obviously your portfolio companies, but also to the ecosystem overall. But yeah, thank you so much for taking the time to come on the show and sharing your experience, lessons, and insights.
My pleasure. Thank you so much.
It's a pleasure having you on. Thanks so much, Howard.
Thanks, Rohit.
Cheers. Thanks for listening to episode 183 of the Startup Playbook podcast. As always, full show notes from this episode will be available at startupplaybook.co. I'll be back next week with another episode, but in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.